Hey everybody, Tim Herriage. The Fed minutes came out today. I wanted to just take a minute. a minute. I wanted to take a minute and go over the Fed minutes with you. So let's do a deep dive into the Federal Reserve meeting. We'll talk about the way they see inflation, the way they see the GDP, the GDI, and ultimately what they're talking about with interest rates. So the FOMC, the Federal Open Market Committee, met on June 13th and June 14th of 2023. So when the Board of Governors come together at the FOMC meeting, they discuss the current economic conditions and they make decisions about monetary policy. You hear them talking mainly about interest rates, but there's a lot more to that. So some of the key takeaways during the meeting, a lot of the Board of Governors, the members, discussed various aspects of the economy, including economic activity, which is when they talk about the gross domestic product and the gross domestic income. Credit conditions, they talk about what's happening with available credit, and they really look at how things are going, and they noted credit is definitely tightening. And then they look at inflation, because ultimately the Federal Reserve has a two-part mandate, a dual mandate, where they are supposed to keep inflation in check, but also ensure maximum employment. So those two aren't necessarily working together right now, which is kind of causing some problems, right? Because right now the economy is expanding. It's growing at a pretty rapid pace. And there's job gains are still great. There's more jobs than there are job seekers. So there's a really low unemployment rate. So if you look at the Fed's job, right, as the way Congress has told them, right now, inflation is high and joblessness is low, or the unemployment rate is low. So they're doing their job in one spot, not in the other. So they're kind of thinking, okay, we can raise unemployment a little bit in order to get inflation down. And that's kind of where the interest rate policy comes from. So then you look at the way that ties into monetary policy, and what's going to happen is when they look at inflation, they set a target rate for the federal funds rate. Right, and so this doesn't have anything to do with the mortgage rate, but it does. So that means short-term rates will go up. So the Fed's, what it costs to borrow money from the Federal Reserve goes up, so everything else goes up with it. But as an investor, you've got to know that your money is going to be tied to short-term rates, not long-term rates. So what's going to be kind of weird is you may see mortgage rates going down on the 30-year fixed homeowner loans, but you'll see investor rates going up, because investor rates are tied more to the short-term rate versus the long-term rate. And we'll talk more about that in just a second. So basically, the committee decided to pause in June. And what does that mean, pause? It just means they didn't raise rates, but that doesn't mean they're done. And it definitely doesn't mean that they're going to start lowering rates. As a matter of fact, when you look at the minutes that came out today, a lot of the members actually wanted to go ahead and raise rates in June, but they didn't. And these minutes kind of have us thinking that we will see a rate increase in July when the FOMC meets again. So when you look at the meeting, they really looked at their projections on real gross domestic product growth, unemployment rate, and inflation. These projections are based on their assessments of appropriate monetary policy and other factors. And so when you look at what they're thinking, they're still predicting the GDP to grow. They're still predicting the unemployment rate to go down. And they're still predicting rather high inflation. So these projections are making the Fed, the FOMC, think that they may need to raise rates again. So when you look at ultimately the Fed's commitment, they are committed to achieving maximum employment and keeping inflation around 2%. And it's well above 2%, as we all know. So I imagine that looking at the minutes, there's a lot of discussion about future rate increases. There was kind of a split vote on whether or not to raise rates in June. So I'm thinking we're going to see some higher rates. I think the Federal Reserve will raise their rates in July, which will then make the short-term money more expensive. We still have this inverted yield curve, right, where short-term money is more expensive than long-term money, whereas in a normal environment, long-term money should be more expensive than short-term money. So as a real estate investor, the summary, look, the high rate environment on DSCR, debt service coverage ratio, investor loans, fix and flip loans is not going away. It could go up from here. I still think we see mortgage rates go down into the high fives, low sixes for homeowners by the end of the year, which should definitely help the housing market. But there's no inventory. Rates are higher than they've been in 20 years. If you're feeling like this is over, it's not. Stay aware, stay alert, and good luck investing out there. I'll talk to you guys soon.